Now we're going to look at unit labor costs, what is happening at small businesses, just to kind of give some of that other side to where some of these inflationary pressures can come from. So one of the things that we've seen, and I think this is a good chart, unit labor costs are, when according to Pantheon, is the best leading indicator. And when you look at unit labor costs year over year, advanced 3 quarters, core CPI year over year, that's where you see some of that pause. But the offset on labor is, and this is what we talked about at the very beginning of segment 2, wages just haven't really gone up because you're seeing some of this pressure set, and it's a matter of, or is it high income earning person, or is it maybe two or three low income earning people to offset? And again, trying to get employees to do more. So you're trying to do more with less. I mean, anyone who's been to an airport, it is very clear they're running with 40% less people, or an airplane, or going on a plane, going to a restaurant. There is a lot of slack in the sense of they're trying to be as lean as possible because there's so much cost in other parts of the business that they're trying to avoid some of the labor costs, which should start to come down a bit when you consider where some of the shifts are on the front of where some of the shifts remain when you're looking at underlying people working, and I guess it's who isn't working. So when you look at the expiration of the government subsidies, that's going to push people back in, and that should help bring some of that labor cost down, or at least create more competition, and then somebody at least will be willing to take that job. But then when you look at jobs growth, so it's a bit of a somber tone from the Bureau of Labor Statistics. Latest estimate for job growth, U.S. is expected to create 11.9 million jobs through 2030, but bulk of that reflects recovery from pandemic compared with 2019 pre-virus peak. Job gains will be just 2.6 million, weaker than in previous decades. So that is the conundrum here, because when you look at what jobs are being created, we're really not creating jobs, and we still have a population growth. We still have some of this capacity. So even though it looks like we're going to have this huge shift higher, it's really not that much in comparison to where we are. So we do have people dropping out of the workforce. You do have that boomer generation. They're baby boomers because that was the big shift higher. You'll see some opportunity open up, but it's still going to be a struggle to get some, and what is a good paying job? How much of these elevated levels are going to be available? That's where we continue to see some of this struggle and some of this strain as we go forward. But then when you look at small business job openings, hard to fill, again, shifted higher again. Small business quality of labor, single most important problem. So they're still struggling at the quality side. Now, if you're expecting to replace a top performer with 2 weaker performers, you have to also lower your expectations, which sometimes I don't think companies are very good at doing that. But they're still struggling to fill positions, and it's just the quality that remains the biggest hindrance to getting people through the door. Then when you look at small business, higher selling prices, they're trying to push through more selling prices. And then when you look at small business pricing plans, they continue to remain at all-time highs when you look at just the amount that is being pushed through the underlying system. So again, you're still seeing this pressure, but with all of this being said, they're still taking CapEx higher. They're still looking to hire. So their hiring plans are still strong. CapEx is still strong. So they're still trying to hire. But and this is where we have to go on both sides of the equation when we're looking at the underlying quality labor problem. Because is it a quality problem, or is it just there's so many people waiting for work, you're getting nitpicky on that quality? And again, it's a survey, so it's open to interpretation. And there's truth on both sides of that. So, but without a doubt, they are expanding. And then when you look at, there was a slight tick up in a small business optimism in August to 100.1 versus 99, an estimate of 99, and 99.7 in prior months. But on the employment demand, still very strong, but outlook is getting weaker, with negative 28% of firms expected better economy, which is worst read since January of 2013. So business conditions have gotten worse, even though the optimism index is kind of flattish. So it's kind of a conundrum, because you're looking at it, you're like, well, but how does this make sense? Like, did you fill in the wrong bubble? But you have to look at the business conditions, and this is weighted towards a Republican bent versus a Democratic bent. So there is some concern about what is the tax rate going to be, because when we look at what was being said, the Democrats are trying to push something closer to a 20% tax rate. You're starting to see some of that come through on general business, the outlook on those conditions. They see tax overhang. They see some of this pressure in terms of inflation, which is keeping that muted, while they're still optimistic about what their company can do. It's just, what is that going to yield, is where we're starting to see some of this bifurcation in general. But this is also another issue. When you think about getting people back in through the door, it's who is in the driver's seat. If you have to go to the office, if I have to go to the office, I will consider looking for another job. Excited about returning to the office. And you look at it, less than 25% are between definite to unsure. But not excited about returning to the office, about 60% are in that camp of either definitely, probably, or unsure about getting back into the office. So this is this backdrop of, I don't think we get that full-time work, that full work from home, but we will see that flex schedule. We will see some of this backdrop as the uncertainty shifts, because people just don't really want to be in the office full-time after experiencing the commute and all that for years, and then not having it for over a year has been a blessing for many. Let's put it that way. So then when you look at the no let up for permanent peak in August, so when you look at U.S. imports, so now when we look at pricing, so this is factoring in PPI, labor, and then the productivity of labor, U.S. imports continue to go up in terms of that peak level when you look at the amount of assets coming through as we continue to pull in from the international market, we continue to import in general. But when you look at the federal deficit, again, coming back to taxes, optimism for businesses. So right now they're saying that they're going to hire, but this deficit's going to have to get paid with something. And what is that going to get paid with? We're going to borrow, and we're going to have to raise taxes in order to meet this deficit, which is also putting pressure on that wealth accumulation. I always think these are interesting charts to kind of put back and forth when you look at wealth accumulation through the ages. So baby boomers, from this point in time, going from 1990 to 2021, you've seen a share of total wealth at over 50%. Generation X, going from 1992 to 2021, you're at about 27%. And then you look at millennials from 2008 to 2021, you're at about 7%. So when you look at just this wealth accumulation through the ages, and given when you look at just in general, wealth by generation and by the midpoint of the cohort age range. So there's been a lot of struggle, if you will, in terms of trying to get ahead, just based on, the millennial side came aboard. And it's actually gotten different because I'm a millennial and I started in the workforce in 2006. But from 2006 to 2021, it has been a struggle to accumulate wealth. I mean, given if you bought S&P 500, Tesla, all of these high flyers, you did great. But getting the down payment to buy a home, getting above that hurdle to accumulate wealth, because we saw wealth accumulate more in assets than anything else. And that's where we see some of the shortfall. And I accidentally took out a chart on it, but you can see just over time how that has shifted, and that we're at this extreme. And it's really assets that have driven this wealth accumulation, not as much on the portfolio. That portfolio has done well, don't get me wrong, if you have a 401k pension, but it's the assets that are missing. And that's something that the millennials and even Gen X to a point have missed out on, because a lot of that is still locked up by baby boomers and the like. Then when we look at revolving credit, so revolving consumer credit owned and securitized continues to go higher. Non-revolving consumer credit owned and securitized, again, all of this is starting to recover. The revolving consumer credit side will continue to go up, especially given just how easy credit is at this point in time. But then when we look at the recovery, has been mostly led by tech-related investments. And when you look at the way business investments are going, this is what we've talked about, on a CapEx side. Even though these small businesses are increasing CapEx, where is it going into? And that's when you start looking at information processing, software. So when you look at hardware, you look at software, that's where we're seeing a lot of this spending. It's not on manufacturing, power and communications, health, commercial and health, or definitely not structures, but replacing structures, replacing people coming to the structure. And that's where you see a lot of this spend on equipment in terms of information processing. That's work from home. Those are servers that can manage those dummy computers when you log in. And these are things that we have to appreciate as we go forward, and looking at the tech shortfall. What is that the technology or semiconductor shortfall? A lot of that can be attributed back to this demand. Oh, I did leave it in. Here it is. And so, but retail sales and inventory, again, this is what we continue to see. When you look at adjusted retail sales and seasonally adjusted retail inventories, we're still at these historic stress levels, which is why consumer companies keep buying and are forced to try to maintain some of this, which is the perpetual supply issues in the market. Then when you look at U.S. credit and debit card spending at restaurants, they continue to start to, again, come back down. This is a mixture of little less money in the pocket, little bit more pressure, and people trying to save money and cutting back on some of this key spending. So then when we look at the ISM backlog indexes based on the percentage of respondents. So when we look at order backlog continuing to go up, non-residential fixed investment coming back down. And here's the different shifts. So order backlog growth has continued to remain elevated, and then the change in private inventories coming back to those inventories. You're starting, and given the credit and debit cards looking at restaurants, but that can be extrapolated out as we're starting to see. So you're starting to get some of that demand slow down, and some of that backlog is starting to clear as these companies try to, again, rebuild inventories given how stressed that inventory level is. So, but then when you look at how are people spending their money? Well, annual apartment rents were up in all the top 30 U.S. metros, and that's everywhere from Phoenix at 22% to Dallas at 10.6%. And then when you look at Baltimore, all the way down to San Francisco, and now New York is surging again. So this is only looking at August. So as we go through September, you're going to get another huge spike up, and just gives you an idea of that pressure point on the inflationary metrics that's going to continue over this time period. So then when you look at total merchant wholesalers, and this is except manufacturers, sale branches, and office inventory, again, you're looking at just these wholesalers. So you have backlogs coming through, you have people trying to rebuild inventories. That will be some of that backdrop, but you have, what are people spending money on? Well, they're going to have to spend more money on rent, so that you're seeing demand come down a bit, which is going to help some of this come through, and some of these inventories get rebuilt, which is why they do go hand in hand, as people are going to spend money differently as they have to now pay for rent after maybe the moratorium. They got a little lax on their payments. And then when you look at just where things are going on the July HPA, you're pulling back a little bit because the HPA will moderate to a still high rate of 13 to 14%. So it's not like it's going to get any better going forward as we go through September into October when we're looking at those rates in general. So then when you look at total non-farm job openings, here's where you're seeing these hiring. So again, the level of 1,000 in terms of just how tight the jobs market is how. But how? And that's where we keep coming back and ending on this level. When you see those percentages and coming back down, well, there's not as many jobs available as people searching for jobs, but what is the quality of the job? What is the pay of the job? And now we didn't talk about it in charts, but just to talk about it in terms of where things are going forward. So when we look at Empire Manufacturing, it's up. It went from 17.9 to 34.3. So you got some of that movement. Import price index was expected to be at 0.2%, came in at negative 0.3%. Export prices, and then import price index year over year was expected at 9.4, came in at 9%. Export price came in line at month over month, was expected at 0.4, came in at 0.4. Export price index was expected year over year at 17%, came in at 16.8. So you're still seeing that import prices came down a bit, which is a positive, especially against, but when you look back after everything we've said, there's still a lot of pressure to the upside. There's still a lot of movement to the upside on that pricing, which is going to be something to watch. And we'll talk about that more next week when we get a bit more data to try to line this up with retail sales and what does that mean going forward. But now that we've talked a lot about the US, we get to turn to Europe and what are some of the shifts that we're seeing within the European theater.